Good morning. It's Friday, May 9th, and thank God it's Friday. It seems like a long week here. So I'm Philip Streible, Chief Market Strategist at Blue Line Futures. So I'll give you a recap of yesterday's price action because it was quite volatile. We did see the first trade deal being made featuring the United Kingdom, and markets are finding some relief. The volatility index fell and U.S. equities climbed. Treasuries sold off aggressively as the U.S. dollar squeezed higher. Safe haven assets such as gold, the Japanese yen, and the Swiss franc, they were all on their back foot too. We saw President Trump, he sounded optimistic of other deals coming out where the U.S. and European Union officials are reportedly talking now, and U.S. and China officials, they are going to be speaking over the weekend. Now, it's been a volatile overnight session here with precious metals and industrial metals, energies, anything China related and commodities had really seen quite a wild action. Copper, one of the markets on my radar here, dipping back down to longer term support, just probing below that 450 level. A lot of times amateur traders put their stop losses just below these psychological levels here or just above if they are short, and the markets tend to probe and hit those stop losses before recovering back to the upside. Now, copper's been a market on my radar, and the Chinese trade data released on Friday showed that total exports rose 8.1%, slightly more than expected, while shipments to the U.S. slumped 21%. That's their export trade data. Now, copper concentrated imports into China rose to 2.9 million tons last month. That's been the highest on record, and this comes despite the global concentrate shortage. The global copper market has been showing some signs of tightening and further tightening ahead. So what to watch over the weekend here? The Trump administration is considering a significant tariff reduction in talks with China, aiming to reduce tariffs below 60% as a first step. So the goal is really to de-escalate this trade war. So I'll be watching the price action Sunday night here, and that's one of the reasons why you want to have a futures trading account, because of the fact that these markets are global and they often move here about 23 hours a day on the futures side. They really move 24 hours if you look at the price action on the cash and on the physical side, where if you're trading in a stock account and an ETF account, you're really doing yourself a disservice here because of the fact you can't try and take advantage of some of these opportunities here because we've seen a lot of volatility in the overnight session. Now, looking at these markets here, you have the S&P 500 up about 15 points, just below that 5,700 level. The NASDAQ up 81, just over that 20,200 level. You got gold up $23, but again, a wild range in the markets overnight here. So looking at the precious metals here in the gold market, again, up $23. That's up just under about 1% at 33.29. The low in the overnight session was 33.78. Saw a lot of you picking up some of that gold at 32.82. And then on the silver market, getting down to about 32.36 on the overnight lows, trading at 32.72. So if you get the chart pack, you look at the silver market, kind of just in the middle of this range here, trying to figure out what it's going to do here. And I think it's taken some cues here from more of the copper, the industrial metals, things like that. So we're looking for some kind of recovery in copper, some kind of breakout in the platinum market, perhaps palladium, perhaps things like that. So in order to get those cues here and less reliance on that gold market. So taking a quick top-down look at the gold market, because it's essential to take a step back and analyze the dynamics. We were playing this gold market to the upside for so long here. It's important to see when you get to these types of levels here, what are the things that could possibly take things down? So consider it checks and balances, and it's kind of taking a step back and look at the dynamics and the main drivers of any market here. So obviously, front and center, tariff negotiations here. Are there progress being made? Because that's a headwind for the gold market because of the rotation we see into other risk assets. Or is it something where we see a deterioration in trade negotiations and people need to find that safety again? So it's something you really want to watch because of the fact that these markets, they kind of get this relief phrase and then they re-examine what's going on in the market and then they start to trade accordingly in some certain direction here. So central bank demand, that's also been another thing, and that's an aspect that silver does not receive in comparison to gold. How much central bank demand is out there, and it's driving the price action of the gold market. We've really seen central banks step up their purchases in gold specifically since the U.S. since Russia and Ukraine and that conflict going on and a lot of sanctions coming on Russian assets, they were the first central bank to really step it up here. That was an outside and an outlier here as far as picking up those gold and gold reserves here. So gold is better suited to be stored rather than silver because it's twice as dense, which silver tarnishes. And I'm not picking on silver because silver's an industrial metal, and I'll get to it in a second here. So China, they keep adding to gold reserves. They've done it for 6 straight months. The question is, will this trend continue? Is that going to push gold exponentially higher? And also the ETF flows, the smaller investor coming into the gold market here. We've seen a 7.1% year-to-date change here. And the question is this increasing? Is this decreasing? Do you see trade wars and trade tensions come down and the individual investor says, hey, I no longer need to own this gold and this asset, and I need to get back into the Magnificent Seven or some other play here, some other dynamic, rotate into the industrial metals, back into the energy complex, things like that. So we also want to look at the bearish factors when we're trading any kind of commodity out there. It doesn't matter what it is. You look at the US dollar, it's got a 95% inverse correlation. The dollar's back over 100. Do yourself a favor. Take a look at a chart of the euro currency against the dollar, starting to look like it's breaking down, which is going to, because of the inverse relationship to the dollar, you're going to see the dollar index boost up on there. So we'll want to watch the euro currency, see if it could break through some of the overnight lows, some of the critical levels of support, because it could put upward pressure on the dollar, downward pressure on the gold market. So again, checks and balances, things like that. So you also want to look at the Fed. Where are they at? Now we have the Fed meeting behind us, but the Fed said that there's a lot of uncertainty. They use the word wait like 25 times in the press conference here, and the upside risk to inflation and unemployment data due to the tariffs. So we want to see, is the Fed more hawkish or dovish? I think that in September, when they finally get the relief, they'll end up doing a 50 basis point cut instead of a 25 basis point cut. And what that'll do is it'll appease Donald Trump, get him off of Jerome Powell's back, and we can finally start moving in the right direction. Something else you want to monitor, and this has been a real laggard for the gold market here, is that managed money participants. They've reduced as the market goes up, and you see that oftentimes, and you can monitor it from CFTC data. Something we put out in the Metals Edge here is you could see multiple weeks of outflows in managed money. Managed money is just looking for other opportunities out there. So they've stepped out of the gold market, but oftentimes managed money is what drives any of these commodities in one type of direction. So looking at the silver market, and silver, yes, it's a hybrid metal. Get over that. It's not a precious metal. It's not just that. It's more than 50% industrial metals. So, but industrial metals, they lead to underperformance in relation to the gold market and economic downturns and oftentimes uncertainty. You keep hearing about recession talks, you keep hearing about economic downturns, things like that, really traders questioning what's going to happen going forward in demand. But what happens is these markets get this regrowth phase after things come back here, and we see policy action take place. We see significant relief rallies occurs. We go through these periods of choppy trading, and we get the stable growth and the confirmation that confirms that we are coming out of the woodwork on this. And that's where you could see gold futures as trade war tensions die down, as deals be made. There's to be a liquidation in there, and then what happens is people stabilize and they're able to move forward here, and that's where the industrial metal complex really takes off to the upside. So generally what happens is you see industrial metals lead the charge coming out of these types of things, and that's where things like the gold-silver ratio really start to break down. Now you look at the ETF flows from the previous session. We got them adding just a little bit of gold in the holdings. They added a little bit of silver as well. So year-to-date percentage change up 7.2, silver up 2.2, the gold-silver ratio 101 to 1. So we want to continue to monitor 97 to 1. That was the April 23rd lows for signs of a possible rotation out of safe haven assets and into industrial metals. You look at the 2008 financial crisis, you look at COVID. What happens is gold-silver ratio blows out. We get through this cloud. We could see through the clouds. We could see the light at the end of the tunnel. And then what happened was silver significantly outperformed the gold market. So something I do monitor here, besides these fundamentals, these different things that are driving the markets, is the technical price action from a data perspective to identify different trends. So consider it a roadmap. Where are we at? Looking at the silver market. Well, we're down 2 consecutive sessions here. We are slightly higher on the day right now. It's been the largest 2-day dollar in percentage decline since May 1st. We've been down 5 of the last 7 sessions. We're 7% off the 52-week highs, which was 34.89, which happened on March 27th. We're up 20% from the 52-week low. Where was that? Well, that was 26.83. That was hit on August 7th. So other markets that I'm watching here, crude oil futures up $1.27. You get the chart back, double bottom on the crude oil market, breaking through the resistance zone at about $61 here. So where's the next one? Well, remember that old support we were playing together for so long between $63 and $65? That's now the upward resistance point here. So it's important to monitor that. So what happened overnight? Well, crude oil futures are watching trade talks, they're watching sanctions, they're watching U.S. shale production, and they're watching declining rig counts here, because when you get OPEC flooding the market, you get oil prices too low, U.S. producers can't produce at those levels, they idle production. That was Diamondback Energy doing that. And then what happens is you find that bottom in the market. Remember, we say the cure for lower prices is lower prices. People can't produce at these levels here. So the U.S. overnight, they sanctioned a Chinese refinery and individuals allegedly facilitating Iranian crude oil. And the United Kingdom plans to sanction tankers helping the Russia move their oil. So another market here that's on my radar. So look at the daily chart on the wheat market. And nothing I say in here is investment advice. This is just me allowing to air what I'm thinking here and provide some support for our clients and also for our colleagues, so we're all on the same page. The wheat market here coming up just a little bit. Well, wheat supplies are expected to remain tight coming into the new season, leaving the market vulnerable to higher prices if the weather worsens in any of the key growing regions before approaching harvest. So global stockpiles, they are forecasted to hold near the lowest in near a decade, with analysts predicting that world wheat stockpiles in the 2025-2026 season to nudge up slightly to 261.4 tons. So weather risks in high key growing areas such as Russia, Ukraine, Europe, the US, Australia, China, dryness, cold snaps, heat waves, all threatening this wheat output and potentially driving prices higher. So that's not a recommendation, it's just something that's on my radar here. We've been watching the corn market, we've been watching the soybean market, possible trade deals with China, we've been watching other commodities, key bottoms here, like the sugar market, which started to move higher here, like natural gas prices that took off earlier, now starting to slide just a bit here. So we're gonna wanna keep an eye on all these markets, and again, it's gonna be a real busy weekend here. Still trying to get this place wrapped up, tried to buy something to put behind here, and it was sold out. So hopefully this office here still improves and get some furniture going over here, because it's feeling a little bit bare. So you guys got any questions, shoot an email to info@bluelinefutures.com. And remember that futures and option trading does involve risk of loss, may not be suitable to all investors. Good luck, good trading.